Hi, welcome to my YouTube channel, My Solution. I'm Raul. In this video, you will learn about receivable financing. During business decline, like the global crisis, COVID-19 pandemic, many entities find themselves in a very tight cash position because sales decrease, customers are not paying on time, but the obligations must continue to be paid when it becomes due. As a result, the entity would be in a financial distress. And so management will find a way to cope up with their situation, especially when the condition is already critical. One of the many options is to look for cash by financing its receivable. So what do you mean by receivable financing? Receivable financing is the financial flexibility or capability of an entity to raise money out of its receivables. There are four common forms of receivable financing. First is a pledging of accounts receivable. When an entity applied for a loan in any bank or financial institution, the company may use its accounts receivable as pledge or collateral security in case the entity failed to fulfill its obligation. Normally, the entity who pledged its receivable makes the collection and may require to remit the collection to the bank or financial institution in satisfaction of the loan. There is no accounting entry for the pledge receivable, but requires disclosure in the notes to the financial statement. Next form of receivable financing is the assignment of accounts receivable. This is a more formal type of pledging of accounts receivable. It is a secured borrowing evidenced by a financial agreement or financing agreement rather, and a promissory note, both of which the assignor signs. The difference between the pledging and assignment is that pledging is general because all of the accounts receivable serve as a security of the loan. Compared to assignment, it is specific because specific accounts receivable serve as collateral security for the loan. Assignment of accounts receivable may be done on a non-notification basis or notification basis. When accounts are assigned on a non-notification basis, customers are not informed that their accounts have been assigned. As a result, customers continue to make payment to the assignor, who in turn remit the collection to the assignee. While the accounts assigned on notification basis, customers are notified to make payments directly to the assignee. In assignment, normally bank or lending institution lends only 70%, 80%, or maybe 90% depending on the quality of accounts, because accounts may not be fully realized by reason of sales returns and allowances, sales discount, and bad debts. Normally, the assignee charges interest for the loan and a financing or service charge or a commission. The last two forms of receivable financing is the factoring of accounts receivable and discounting of notes receivable. I will explain the last two forms in my next video, so please don't forget to subscribe to watch more videos. That's all for this session. Thank you for watching my video. If you like my video, please give us your comment and don't forget to subscribe. Thank you.